Hi, Greg Hughes here with Hughes Private Capital. I'm glad you could make it today. We're going to talk about being an investor and not a landlord and how we've found one of the most profitable and stable housing categories out there in the U.S. today. So now I know when you listen to this today, you're going to probably have some additional questions. We would love for you to come to one of our events. They happen almost every month. Or if not, just make a phone call or we'll set up a meeting and we can all get together and answer any questions that you're going to have. So let's get started and talk about where is the most profitable and stable housing category out there. And where it is in America's heartland. And we're buying properties that are in neighborhoods that look just like this. And today we're in 9 different markets that are out there. And so we're going to go through and talk about why we think that they're profitable and they're stable and good for an investor. But we're going to also talk about some other things. We're going to talk about what is hard about it. What kind of things could go wrong? Because there's not just always a bed of roses out there on all of this sort of stuff. So we'll talk about that. And I know a lot about what we're going to talk about here today, but I don't know all of it. So with that being said, I'm just going to tell you what I would tell somebody in my family about this type of investment and what I see for the future that's out there. And then as you listen to this, I don't want you to make it complex. It's really simple. You're going to see that we're buying rental properties and it's a buy and hold, and that's all there is to it. There's no magic, there's no complexity to it or anything else. So as we get going, you're going to also probably want to hear about our 1031 exchange, because I know a lot of you guys have come to this to learn about that. And this is really exciting is what we've got going there. How you can do a 1031 exchange and save on all your taxes with it, but even better yet, how you can get some better returns. We're finding that it's at least 2 to 5 times better than what most people have on their rentals. How you can be safer in it because you become much more diversified. And maybe the best of all, how it's 100% passive type of investment for you. So you don't have to do any of the work. Now, you're going to see that this is not our first rodeo. So that's me to the left, and that's my business partner, Steve Sixberry, to the right. We've been around for now almost a decade as Hughes Private Capital. And along that time, we've run multiple funds. One of them is here that you can see. It's called ROI Strategy. So I just want to give you a little bit of background on what we've done. This one's still running today. It's doing well. It just doesn't take on any new capital. It was a fund that we put together to do lease to owns for people. And as you can see, it's returned somewhere between just a little bit below 10% and a little bit below 12%. So kind of in that same range that as we're going to talk about our fund today, Guardian. But this is one of them, and you can also see the blue line there. The blue line is ROI Strategies, and it's comparing to the S&P 500 and the Dow Jones, and you can see the consistency that it's had. It's the same thing for Guardian as you'll see in just one moment. So that's one of the funds that we've run. We also run another different business called Advance Commission. It gives advances to realtors on their commission when they get a property into escrow. So realtors have lumpy cash flows, so sometimes they're looking to get some type of money up front, and that's what we do. We give them an advance. And in this case, investors with us make 10.5% on that. So that's another business that we run. And then the one we're going to talk about today is Guardian. Now, Guardian is at 10.95% on its current net return there, as you can see. Now, Guardian is only a year and a half old at this point, but we've got a lot of experience behind us that has helped to build this. You can see there again on the chart for Guardian, the blue line is Guardian. The green is the Dow Jones, and the purple is the S&P 500. Now, we know that the stock market's been on quite a tear lately. So you can see how well we've even stayed up with that, but you can see more importantly how consistent our return is overall. Now, what's the red line? The red line is a 10-year Treasury bond. That is a very consistent return, we know, but it's also a very low return. So we'll tell you a lot more about Guardian today because that's what we're here to talk about. But before we do that, we have a little saying around here. We like to say we reserve the right to get smarter. So, you know, Steve and I have been business partners now for almost a decade, But we've done lots of other things in our life, right? So it hasn't been just that. It's been over the last 35 years where we've run multiple businesses. We've invested our own money in real estate, our own money in the stock market. And as we've done all that, we've gotten smarter, just like everybody else out there. And things have evolved. And where do you get probably the smartest? Well, it's on things that don't work out, things that don't go as planned on the deal. So that's why we like to say we reserve the right to get smarter. And you're going to see a lot of what's happened and evolved throughout all of this time to get there. Part of that is with Guardian is that we have two principles that we really like to follow that we think are very, very important for investing. And the first one is preservation of principle. Even the old Oracle of Omaha, Mr. Warren Buffett, agrees with us here. There's nothing more important than preserving your principal, especially as we get older. Much harder if we lose money, if we lose part of our principal, to regain that. One of the ways to do that is to actually get into investments that have very low volatility. Now, what's volatility? Volatility is swinging up and down with your investment. Now, that's something we talk a lot about, like say at our events, or if you wanted to even order our investor kit, it'll have a lot of information in there. We're not going to go over much of that today, but what I want to do is make sure that you're aware of that, because volatility robs your portfolio of its return, and that's important. It also makes your investment much more risky because of your buying at the right time or selling at the wrong time, all those different things that go along with that. So big thing, preservation of principle. So I want you just to take 2 seconds and think of a time that you lost money. I bet it comes to you very quickly. I know for myself, I lost $250,000 back in 2002, and it's something that I don't want to experience again. So we work really hard at making sure that our investments preserve the principal. So that's number one. Our second one is consistent return on investment. Now, Guardian is an investment that is all about the cash flow and nothing to do with appreciation. As far as we're concerned with appreciation, that's just gambling. That's really what it is. Because what's about appreciation? It's about buying exactly at the right time, and then even more importantly, selling at the right time. Well, with Guardian, it's all about the cash flow. It's the rent in, the expenses out, and it's a cash flow that you have left at the end. And so we haven't built $1 in there of appreciation, because that's nothing that the model has been built on. The other thing that helps us do, again, is it helps to eliminate a lot of the volatility, and I'll show you exactly why that is as we talk about Guardian here. So let's jump into Guardian and talk about what we're doing there. So Guardian is in 9 different areas, and you can see the 9 different areas here on the PowerPoint, with just slightly below about a 10% net return on that. So we're very well diversified in very different areas there. So one of the things is about Guardian is that it's 100% passive investment for you. We're going to do all the work for you. I'm going to be out there on the old tractor 24/7, whatever it takes to make that sort of stuff happen. But what's really important is there's no work that you need to do. So let's talk about a little bit about what we're doing in those 9 areas that I told you that we're buying in. Here's something that's really interesting, and for some people this kind of blows them away. We're buying homes from about $25,000 to $60,000. That's the range that we buy them in, and we do this very consciously. Now, sometimes people say, I didn't even know you could buy a home for $50,000. Well, you can in America's heartland. Back in the Midwest, that's still possible today. But it's also really important as to why we're buying right there. And the reason is because we are buying in the affordable housing. Now, we're going to add 2 layers to this. First, we're in the core rental market. Second, we're in the affordable housing. And that's really important because affordable housing is the safest place to be when you're investing. That's why we say this is one of the best and one of the most stable housing categories that's out there today. So let's talk about just a few things as to why that is. Well, one, because they're affordable, we can keep these properties rented most all the time. Two, we get a really healthy rent ratio, and we'll talk about what that means overall. And number three, maybe what the most important of all, these homes don't fluctuate in value. Remember when we talked about timing in the market? We don't have hardly any timing in the market. If you look at these properties, they don't go up and down in value. Very, very little. Sometimes they are the same price they were 20 years ago, literally. What does that mean to us? Well, it means that we're not worried about appreciation. We've already talked about that. Also means we don't want to worry about when we're buying the property or possibly selling in the future. Although that selling is not a big part of our model, it's something that we don't want to have to worry about with these deals. So it's a way that we get away from not worrying about timing the market out there. Now, compare affordable housing to something like this. Now, maybe this is a little bit of an exaggeration if you look at the slide. We're not going to be buying houses that big, but when you buy in the more expensive homes, here's what happens. You're going to get poor margins out there. They're going to definitely lose value in the downturn, so you better time your market very well with that. And what also happens is people don't upsize, they downsize when things go bad out there. So this is why we're buying in that affordable housing category that's out there. Now, remember I said that it's hard. So why is it hard? Well, let me give you an example. You can buy one property for $500,000. Okay, that's one property to manage. Or you can buy 10 properties like we do for $50,000 a piece. That's 10 properties to manage. That's a lot to do. And that's why part of this is hard. Now, hard isn't always bad. Now, in our case, we're building the systems, the processes, everything it takes to make that work. We have a great team here that all they do is get up every day and they manage the property managers that are managing our properties out there. So those types of things are already involved. Now, the other piece is that it's hard because you're managing all of those. That also keeps people out of this. They're out of the niche. And so we have less competition because of that. And so that helps to make actually things better for us. So yes, it's hard on this side because you got to really manage everything. But over here, you gain some advantages because of that, on that. So that's why it's hard. I would also not recommend somebody just to run back and do 10 homes on their own back there because it is hard. But as you build the economies of scale, it gets better and better. And that's what we're doing. At this point, we're at over a couple hundred homes, and it's getting to be more and more every day. All right, let's take a look at just a couple of these homes. I love to show these. They almost all look the same. So here's one in Toledo, Ohio, a little 3-bedroom, 1-bath. Here's some insides of what that house looks like. Some nice little green shag carpet there for you. But you can see that it's a nice little home. They're older homes, but they're in good shape, and we keep them that way, and we make them that way. So if we need to put in dollars to get them to that point, then that's what we do. So here's another one that's in Cleveland, and it gives you a little bit of a feel for the inside. Nothing real fancy, but they're great little homes. They're affordable for people to live in. So let's talk some numbers. Here's a typical Guardian home. So it's this is the same one we were looking at in Cleveland, right? It's a 3-bedroom, 1-bath. This is pretty average for what we buy. So somewhere around a $40,000 value, and we're getting $600 worth of rent on that. Now, let's talk about what that means for a rent ratio. Remember, we talked about that a little bit earlier. Is what's a rent ratio? Well, that means what does the rent represent in the home price? So in other words, $600 represents, of the $40,000 home price, about a 1.5% rent ratio. That's what it represents. And if you think about this, most rentals are going to be down as low as 0.5%, maybe up to 1%, always depending where you're buying. But that's how good we get our rent ratios, by buying in these certain areas there too. Now, we're just going to use the net return of 10% because that's relatively easy way to go on this. But what does the net return represent? Well, it represents our vacancy rates, our repairs, our property management, our property taxes, our property insurance that's there, our owner's insurance there, includes the depreciation in there. It's the net. It's truly the net of where we are. And that's something that we can run with these types of homes back there. So now we've talked rent ratio and a little bit about the net return. I also told you we'll talk about some things that could go wrong out there. So what could go wrong? Well, first of all, our neighborhoods could change. We could be buying in a neighborhood today that maybe 10 years down the road, something has started to change there. That's something we're always watching. It's a big deal for us when we're buying, and it will continue to be a big deal for us as we continue to manage these properties that are out there. Another thing is we could have some detrimental laws that are enacted, maybe a rent control. Well, probably not back there in the Midwest. Rent control is much more about the East Coast and the West Coast. So we don't really see that, but that's always something that could be there. And then the last and probably the biggest is having incompetent or dishonest property managers. That's why we've got people here on our team that's their only job, to get up and make sure those property managers are doing their job every day. And of course, we're always looking to work with the best ones that are out there. So far we haven't found any dishonest ones, but somewhere along the line you probably will. So it's not all perfect out there. It takes lots of work to make this happen, but we've got the systems and the processes to do exactly that. Now, if things were to go wrong, what do you want to do? You want to be able to figure out if what would it look like? So we call that a stress test. Now, so on this one, I like this one because we put Steve onto the treadmill, we hook him up to the EKG, and we start running him like crazy. So no, not really. We're not going to stress test Steve. We want to stress test the homes themselves, and it's very actually easy to do. What we would do is we just reduce our rent. So look at this. I think it's kind of an interesting deal here. We reduce the rent by 20%. That's a lot. I mean, something really kind of had to have happened in order to lose 20% of your rent. But it's possible, right? Even if we lose 20% of our rent, we can still produce a positive net return, and actually not even a horrible one at that. We're almost at 6%. Now, that's always give or take. These are estimates of where we would be on something like that. But let's just take it a step further. Let's reduce the rent by up as 40%. All right? Now we're still even in the positive. So what that means is if we had to, we could hang on to those homes, still be okay, reduce our rent way down if we had to attract our tenants in, and still we haven't lost $1 worth of principal at that point, because we can sit on those homes and continue to rent them out if that's what it took on the overall basis for that. Now, how do we mitigate some of those challenges that we have? Well, very easily, and probably number one factor is to be geographically diversified. And it doesn't mean just in the different cities. It even means within the cities themselves. We're in different neighborhoods within those cities, and so every time we do that, it helps us that if one problem starts over here, all these other areas should be in pretty good shape overall on the deal. That's a great way to help with that. Now, the other piece of this is looking at it as a cash flow model again. You look at the way that our returns are for Guardian today. Those returns should stay relatively consistent over time. And what that also means to us is we're not going to get any big, huge bumps, but that also means we shouldn't get any big losses. And that helps along the way to keep, if there are some areas that have some challenges, that we have other areas that are continuing to be in a really nice, consistent area there. All right, well, that's how Guardian, or that's what Guardian's buying, that's how it works and all that sort of stuff. So let's talk about how you can actually participate in Guardian. You actually have two choices. You can come in as an investor, or you can come in as a lender. So you can invest in Guardian and be an owner, or you can be a lender in Guardian and lend to Guardian. So let's just break those two down. All right. If you come in as an owner, so that means you're going to be an investor in Guardian, this is the way that it works. You're going to get somewhere between 9 to 12% on your net returns. Now, as you come in as an owner, let me back up for 2 seconds here and just re-explain that. Guardian is an LLC, so you would come in, you would become a member of Guardian, meaning you're an owner. That's where you're going to get your returns. What's going to happen is you're going to earn a monthly pro rata share of the net profits. Now, what's pro rata mean? Well, let's say that you own 10% of Guardian. That means you're going to get 10% of the net profits each month. That's what that means. So when you hear me say pro rata, that's where we're going with that. The other thing is you can choose to receive either a dividend, so you have some monthly income coming to you, or you can let it reinvest and let it compound over time. There's no lockup period for withdrawal, but you do have to remember we are an illiquid fund, so it doesn't mean that you can come in and just say to us, hey, tomorrow I need to get my money out. You need to give us a little bit of notice and let us know what you need to withdraw out of there. And then last is you can use your 401k, or you can use a self-directed to be an investor in Guardian. All right, now let's talk about if you want to lend to Guardian. If you want to be a lender, it's a little different. You're going to get paid a 7.89% interest rate, and it's a fixed rate. It doesn't fluctuate at all. And your advantage of being a lender is that you're in the priority position. So what does that mean? Well, you're unsecured because you're not secured specifically against a home itself, but you're also secured against the entire fund. So I think this next slide explains it the best way. Right now, today, as I record this, we have $11 million in assets in Guardian. What that means is we've got about $1.5 million of that in the debt side. So that would be the lenders. And then we have the other $9.5 million in the equity side. That would be the investors on that. Well, both of those monies all go into one pot, and we go out and we buy homes with that. But what happens at the end of each month, the lenders get paid out first because they have an interest expense, right? It's an expense to the fund. They're paid out first. And then the net profits that are left over are there for the investors. So the lenders again get paid 7.89%, which is fixed. The investors are going to get somewhere between 9 and 12%. The advantage here again to the lender is they're always paid out first. Even if there were something that were to go horribly wrong with the fund, they're in the first position. So that's the way it works between being a lender and being an investor in Guardian on that. Now, that's the way that Guardian works itself. We're going to now start to talk about 1031 exchanges and how they're tax-free. Now, sometimes people will argue with me here because they want to say it's tax-deferred, and they're 100% right. But when you do a 1031 exchange, it is tax-free for that period of time. And we can talk more about that at another time, some more technicalities about that. But what I want you to understand with the 1031 exchange is that when you do a 1031 exchange into Guardian, as I'm going to show you now, you're going to be treated just like every other investor, or you can actually come in as a lender. It doesn't change from anything that we just looked at in the previous slides there. So I always think the best way to do this, give you a little example. Let's say that you went out and you bought a property, call it 20 years ago, that you bought a property for $150,000. Today it's worth $400,000. Okay, great. It's been a nice little property. You've rented it out. You've done all the things that go with that, but at this point you're kind of done and you're ready to get rid of it. Well, let's talk about a 1031 exchange. When you're going to go sell it, you need to get that into a 1031 escrow account. You can't ever take possession of the money. Once you do, then you can't do a 1031. We can help you to get to the right 1031 company. We're not a 1031 company, and we can help you get all that set up. So you would go out, you'd sell your property, you get it put into a 1031 exchange account. Now, what happens there? When you sell your property, what goes into that account? Cash, right? Cash goes into that account. Now, on a 1031, you have 45 days from the day that you sold your property to identify new properties and 180 days to close. Very easy to do if you're doing it with Guardian. It's really why we call it the Guardian solution, because we've solved this for so many people in not making it a difficult opportunity or deal to go out there and make happen. So once you've got it in your 1031 escrow account, this is the way that it works. You're going to take that $400,000 and you're going to take it and move it out of your escrow account. Now remember, that's cash, and we're going to exchange that in to Guardian and put 10 homes. We're going to just call it 10 homes at $40,000 a piece. It won't be exactly that. And those homes are going to be titled in your name. Whatever your other property was titled as, these are going to be titled in your name. That meets the 1031 requirements. That's what you had to do, move it from one property to another property, and you can do it to multiple properties as we're doing here. You took $400,000, we titled those properties in your name, but you're going to be treated just like a normal $400,000 investor in Guardian. So again, remember that pro rata? We talked about getting your pro rata share. Well, you're going to get $400,000, whatever that represents within inside the fund, of the pro rata share of the net profits of the entire fund. So not just based on your 10 homes. Those 10 homes are just titled in your name. You're going to get it based on all, let's call it 200 homes within inside of Guardian. So Guardian produces a net profit every month. You're getting your pro rata share of the $400,000, whatever that represents, of the net profit each month on that. Okay, now that meets our 1031 requirements, and that helps you to get diversified across a couple hundred homes as compared to just the 10 homes that are there. Now, what happens if we have to do some repairs or maintenance to those homes? It's the exact same thing. Guardian takes care of that, and because those homes stay within Guardian and continue to produce the net profit for everybody within inside of Guardian, that's the way that that works there with Guardian. So, all right, so now what happens if one of those homes or all 10 of those homes for you have gone vacant? It doesn't matter, because all that matters is that you've got those homes and those are titled in your name there. So in that case, yeah, it's not helping Guardian to have all your homes vacant, but for you, it's not adjusting that or anything's changing for you overall. You're still getting a complete part of the total amount of all the homes there. All right, well, someday along the way, you're going to want to withdraw your investment. How does that work for you? Well, you come in and tell us you want to withdraw your investment. We usually cry a little bit. We don't like to see our friends go, but it's actually very easy the way that it works. Now remember, you brought in $400,000, and we're going to just take those same homes, we're going to title them back into Guardian's name, and the $400,000 that we consider to be your principal that you invested in is coming back to you. And then of course you're going to get any return that's owed to you. If you've taken it out as a dividend, then there isn't any additional, but if you've let it reinvest, then you're going to get that back. And of course, it doesn't have to be the entire amount. It could be proportional to what, you know, or a portion of, I guess I should say, of what the way you want to withdraw. But very easy to do. You come in, you tell us what you want to do, and it's easy to withdraw your money on that. What about doing a portion of? And you're in a 1031. This is actually cool because you actually have some additional flexibility. So you have now 10 homes instead of one home. Let's say that you come in and you say, I'd really like to just get $80,000 out. We say, okay, well, let's just do this. We're going to retitle 2 of those homes back over to Guardian. We're going to get you your $80,000 out on that. And the beauty is, if you don't do another 1031, because that is an option for you, you can just pay the taxes on those 2 homes. So the beauty is the rest of those homes, you don't have to pay any of the taxes on. This still stays in there under the 1031. And you have the flexibility to make this work however you would like. All right, now another thing that we run into is that people end up having debt, right? They own a property, their $400,000 property has got $120,000 worth of debt on it. Not a problem. What we're going to do is we're going to bring you in, and you're going to become a $280,000 investor for us. We're going to loan you the other property, so you're going to get all 10 homes. They're going to be all titled to you. We're going to loan you, in this case, in this scenario, 3 homes. You're going to get the title to those. You don't have to worry about paying any debt down on any of that sort of stuff. It's just their loan to you, again, to meet the 1031 requirements there. In this case, you've come in as a $280,000 investor. You're going to get that pro rata share of what $280,000 represents on the net profit each and every month. Or if you're a lender, you're going to get paid the 7.89% fixed interest rate on that, whichever you decide you want to be with that. But we've got that part handled for you. And then last thing that we'll talk about in this part of it is just, say you're a partner with others, and we're going to call it Big Building LLC here. and you want to do a 1031, but the rest of your partners don't. This is not a problem. You would take your portion out. You can do it. We're going to title it in the big building LLC side of it, and then there's some other technicalities there that, but unless we'll talk to you about that in person. That's an easier way to make that happen. But I want you to know that if you ended up being in a partnership, an LLC, something like that, you can still make this stuff happen. All right, I always like to run a little bit of a kind of a scenario so you can kind of see this, because I just think it's kind of fascinating the way this works. But how much more could you be earning as a Guardian Fund investor that's out there? So we're going to just take a typical investment property, do a 1031 exchange, and do it into Guardian Fund. So we're going to start with that $400,000 property. Okay, that's the value. You're going to do the 1031 exchange. As an example, and we see this all the time, this is not far off at all. A $400,000 property may be netting somewhere around $1,500 a month. Okay, now one of the problems that people have, it's a good problem to have, but it is a little bit of a problem, is that you're not utilizing all your equity that's out there. Because you've built this up over the years. You've owned this property for 20, 25 years, and now you've got all this equity built up in it. So we see this all the time. Normal rental property, they're netting out of that $1,500 a month. We're going to compare it to a 10% net return with Guardian. So what's that look like? Well, you know, it's $1,500 times 12 is $18,000 for the year. But look at what happens with the Guardian Fund. You've moved that same exact $400,000 to making $40,000 a month on that. So that's more than 2 times the amount that you're making on your property today. This is not unusual at all. Sometimes we see it to be far greater than this, all depending on the situation itself. And that doesn't mean that you weren't making a good return on your other property, because you probably bought it for a lot less. But your total of dollars of what you can make is a lot greater usually when you do a 1031 into Guardian. Now let's take a look at what happens after 10 years. Well, same typical investment property. You've got original investment of $400,000, and we're going to compound it for 10 years. Now, I can't figure out what you can compound your $18,000 for, because I don't know what you're going to use that money for. But if you take the Guardian side and you compound the $40,000 for 10 years in a row, you're going to come out with $682,000. Big difference on that. Now, obviously, you can do better than that with your typical investment property, but you got to get that $18,000 reinvested in order to do that. That's super easy to do with a Guardian Fund. And then last number we're going to look at is, let's look at as if we sold it all off, we were done, we sold the property off, you might have $580,000 there, as compared to having in the Guardian Fund where you have over $1 million in there. Not quite twice as much, but darn near. And the beauty of all that is that you didn't have to do anything. It was a passive investment for you that entire time. No leaky toilets to take phone calls for on that. So real easy little deal to do. Take any property that you have, figure out what your net profit is, multiply your equity, total equity times 10%, and it gives you an idea of how you could do with this type of deal. Another thing that we have out there for you is a calculator. If you go to 1031calculator.com, or you just go onto our website, which is hughescapital.com, you can run it. It will literally take you 3 minutes. You don't have to look up any fancy numbers or anything. It's going to ask you a couple of questions, and you can immediately see how much you can save in taxes by doing a 1031 exchange. And then on top of that, figure out what that means to you. If you're going to save $50,000 or $100,000 in taxes, which is very common, what does that mean for the future as well? Because you haven't given that to the tax man, and you're continuing to make money on that money. That's a big difference, especially over a long period of time. All right, that's pretty much the 1031 stuff. We're going to talk about a couple things, and then we're done here. But I think maybe the most important thing about everything we're going to talk about here today is know who you're doing business with. Now, in this case, this is not Steve and myself behind those masks, I promise you. But we know there's a lot of people that are out there that are behind those masks. And so one of the things that we really encourage you to do is I know this is great. You can see me and you can maybe get a little bit of a feel for me through this webinar, but what we really like you to do is to come meet with us at the very bare minimum, have a phone call, all those types of things, because this is the most important thing, is who you're doing business with. We can go to lunch, we can go to dinner, and whether or not you're talking to myself or Steve or Stacy, you need to get to know us, and then we'll take it from there, from being able to spend some time and to get you comfortable with who we are and what we represent. So anyways, we're really glad that you joined us today on Be an Investor and Not a Landlord, and we hope that we're going to be able to see you in the future. And until then, take care. Thank you for joining us.